Good morning and welcome to the Facilities by ADF PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to John Richard, Chairman. Good morning, sir.
Good morning. And good morning all. Presenting with me today on the far side, Marsden Proctor, Chief Executive, and in the middle, Neil Evans, Chief Financial Officer. I'd like to begin before passing on to Marsden and Neil by just talking through a few highlights on the following slide, please. Facilities by ADF PLC, we work with the world's largest production companies like Netflix, Amazon, Sky, Disney, Apple, and many others in the film and in particularly the high-end TV arena. We now have over 700 vehicles, costume trailers, artiste trailers, makeup, production offices, diners, schoolrooms, toilets, technical trailers, and our tractor units. And this compares to around about 500 at our point of IPO in January 2021. We're a high volume Albert approved operator, very important because Albert approval is the gold standard in sustainability demanded by most of these studios now. And we have a fully managed 24/7, 365 service. The industry was worth 6.3 billion in the UK last year, and this is anticipated to grow to over 11 billion by 2026. Half one 2023, we were at revenues of 21.8 million, 73% ahead of half one 2022, and EBITDA of 5.8 million, 117% ahead of half one 22. We acquired Location One Limited in December 2022, and that's proved to be a real success for us. We've opened new facilities for them in Bridgend, Glasgow, and Longcross in Surrey, and we're looking at new and diverse acquisitions to utilizing our funds raised at IPO. We opened our new flagship operational hub in Longcross, Surrey during the first half of this year, and that's proving to be a great success. Great location. It's near Elstree and Pinewood and Longcross and Shepperton, etc., etc. And it's built for purpose. Very, very important for us. We're proposing interim dividend of 0.5 pence per share, and the full year 2022 interim dividend by comparison was 0.46 pence per share. It's important to note that half two revenues of this year are impacted by the current artist and writers' strike in the United States. As it says, revenue is expected to be no less than 35 million for the full year, but it's important to note that that's going on, and I believe all parties are sitting down in California today and discussing hopefully a way forward very soon and an end to that strike. But moving on to our market and more details of our business in the first half of this year, CEO Marsden Proctor.
Okay. Good morning, everybody. So as you're aware, as John alluded to, the TV film industry in the UK has been experiencing industrial action. The Writers Guild of America has been on strike since the 2nd of May, with the Screen Actors Guild joining the strike action on the 14th of July. The ongoing labour dispute with the Alliance and Motion Picture and Television Producers, which is the streamers and studios, is based around increased contracts, salaries, residuals, limiting the use of artificial intelligence and healthcare. The strike has caused significant disruption in general to the UK TV film industry, along with several high-profile US productions that ADF were working on had booked in when the strikes were announced back in July. These, as a consequence, were put on hiatus. Over the course of the following weeks, many other shows were put on hold or pushed back to early 2024. This means that there will be the inevitable knock-on effect, with all future productions now in a holding pattern until the strikes are resolved. Conversely, while the US strikes affect many productions in the UK, there is still a large number of productions unaffected that are going ahead with UK writers and actors. To put some perspective on that, we would normally be servicing between 20 to 24 productions at any one time, and at present it's around 15, which is extremely positive when you take into consideration our main competitors are doing between 2 and 3 productions each. ADF has a current pipeline of confirmed and very likely to win work between now and the end of the year, which will generate full year sales of 35 million. There was some positive news last Friday when the unions announced they'll resume talks with the studio this week. And as John alluded to, they met yesterday. It's reported the talks were very encouraging. Several top CEOs joined the talks: Bob Iger of Disney, Ted Sarandos of Netflix, and Donna Langley of NBC Universal. They concluded late afternoon with a plan to continue negotiations today. Once resolved, we believe that there will be a very heavily up demand as experienced post-pandemic. Yet despite the ongoing strikes, there is a strong and resilient market in the UK. We have world-class facilities and studios and an English language environment. A long history of experience of filmmaking and highly skilled domestic workforce, unlike our American friends, non-unionised. A compact, low-risk geography with a wealth of accessible landscapes, cities, scenery and heritage locations. The UK government offers favourable tax incentives at 25% for TV and film productions, which was reconfirmed in the spring budget. And with Europe being so easily accessible, it gives productions the opportunity to dip into other territories to take advantage of their tax incentives. So the underlying market conditions and drivers are still providing a high level of confidence that ADF services will continue to grow for the foreseeable future. The continued growth in paid-for streaming services in the UK is forecast to overtake traditional paid-for services, BT, Sky, etc., by 2025. Streamers and studio owners are continuing with their relentless procurement and development of new studio space. If we could move on to the next page, please. So our customer base, in the first 6 months of 23, we have completed 46 productions and we expect to complete 90 by year end. We have currently 79 productions either completed, currently filming or booked in, and the average revenue per production for H1 was 361,000, an increase of 85,000 on H1 2022, which does not include Location 1. And during the first half of 23, ADF and Location 1 jointly pitched for and won 9 production. The largest platform, as in most recent years, was Netflix, with 21% of revenue, and the booking lead time was circa 7 months prior to the strike. The full year order book for 23 was extremely strong prior to the start of the strike, with several new and repeat large productions booked in. The strike has undoubtedly impacted FY23 revenue outlook, which is currently forecast at no less than 35 million. Next slide, please. So moving on to our growth strategy. ADF continued with its strategy to grow its footprint and market share with a high level of capital spend in 23. The objective was to reach circa 750 assets by year end. At the start of 23, we had 602, and by the end of H1, this had increased to 700. We accelerated the orders in the first half of the year in advance of the anticipated withdrawal of the 130% super deduction capital allowance regime at the end of March, which was subsequently continued in a similar format. And since the onset of the strike, we've put the remaining orders on hold until this is resolved. Next slide, please. So moving on to our growth strategy. Location 1, our first acquisition, is now fully integrated into ADF systems and processes and delivering the expected efficiencies. We've consolidated IT systems, insurance, HR support, finance procedures and reporting, sales and CRM platform. We've subsequently opened 2 new depots at ADF sites in Wales and Longcross and a joint new site at Pioneer Studios in Glasgow. And we're continuing to assess other acquisition opportunities in line with our investing criteria and IPO commitments, and with currently 5 or 6 opportunities at various stages of development with parallel or diversified business activities, but still centrally focused in the TV and film industry. And with that, I'll hand over to Neil. And the next slide, please.
Okay, quick run through the numbers, starting with our P&L. So as John mentioned earlier, we had a really great start of the year, following on from the back end of last year with generally bigger and longer productions. Revenue was up 9.2 million compared to H1 last year, an increase of 73%. 5.2 million of the increase came from our new acquisition, Location 1, which was in line with what we expected from them. and 4 million of the increase came from the core business, which like for like was 32% up on H1 last year. The productions we worked on were more concentrated around the big London studios and the other regional locations that we could more easily service. Now, that meant the transport and agency labour costs were a lower percentage of sales, and hence gross margins improved from 33% in H1 last year to 39% in H1 this year, which is exactly what we expected with the move to Longcross from our old base in Borden, Hampshire. So adjusted EBITDA was up at 5.8 million, 27%, and ahead of H1 last year, which was 2.6 million and 21%. There's no corporation tax charge payable because ADF's got excess capital allowances, so the tax charge is there, it's just deferred tax. And the profit after tax, therefore, was 2.5 million, just under 12%. As John mentioned, in terms of dividends, we paid a final dividend of 0.9 pence per share in relation to last year in June this year. And we're proposing to pay an interim dividend of 0.5 pence per share for this year, which compared to 0.46 pence per share last year. So that'll be paid on the 27th of October to shareholders on the register 6th of October. Next slide, please. Quick look at the balance sheet. As Mars mentioned, we've really accelerated our CapEx plans right from the start of this year to take advantage of the super deduction capital allowance regime that was in place for the last 2 years over COVID, which was due to come to an end in March, but has now been held over for another couple of years by Jeremy Hunt, more or less in the same format. In the first 6 months, we spent 9.4 million and acquired 108 units. We sold a handful of older assets in the year, so the net increase in the 6 months was 100 units. And in terms of CapEx pipeline, we currently have undelivered orders for this year of about £5 million that we put on hold in agreement with our suppliers to deliver after the strikes are resolved, which will probably be, the early parts of next year now. We always aim to fund about 50% of our CapEx via hire purchase, individual hire purchase agreements secured on specific assets, and that's the only debt we have in the business. And the hire purchase balances at the end of June was 17.2 million, and the cash on the balance sheet at that date was 7.3 million. So the net debt in the business, hire purchase less the cash, was just under 10 million, 9.9 million, and that's really it on the balance sheet. Next slide, please. Quick look at the cash flow. Overall, there was a net cash inflow of 4.5 million from operating activities, and that includes a negative movement in working capital of 1.4 million H1 from the underlying increase in sales levels with Location 1 now part of the group, and also the payments of some legacy tax liabilities provided for at the time of the IPO. Of the 9.4 million capex I mentioned, we paid 3.4 million of that in cash, and the rest, 6 million, was paid by hire purchase. In the 6 months, the total hire purchase lease repayments were 2.6 million, and as mentioned, we paid a dividend for last year of 725,000. So that all meant that the cash at the half year end was 7.3 million. Over to John to summarise.
Yeah, so we are very much the leading provider of premium production facilities, and I think that's accepted within the group in the industry. We promise a progressive dividend policy, and that's exactly what we're delivering. There is a limited supply of top-end premium production facilities in the UK, giving us a strong commercial advantage. And as Marsden has emphasised, the UK remains and is increasing to be a world-leading destination for film and high-end TV production. The market drivers are very strong, and there's a real platform for growth. To repeat myself, £6.3 billion in this industry in the UK in 2022, rising to over 11 billion by 2026. People want to do productions here. We have great earnings visibility, as quite often things are booked up 9 months or more in advance. We do have some current market headwinds, as we had during COVID, but they're expected to be short-lived. And once these strikes are resolved, the team expect a surge of film and high-end TV production to suddenly come our way. We've invested in the right teams and the right resources to enable us to scale, and our acquisition, as Marsden said, of Location One has been a huge success, not just in the services they provide, but in high-quality people as well. We still have some of our IPO proceeds giving us the opportunity to execute on that growth strategy, and we aspire to 100 million of revenue by 2026, and we're looking for complementary acquisitions as part of that strategy as we speak. So we pause for questions.
Fantastic. Look, thank you very much indeed for the presentation. Ladies and gentlemen, as John said, please continue to submit your questions using the Q&A tab just on the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question, press send. Just while the team take a few moments to review those questions submitted today, I'd like to remind you that a recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. John, as you can see, we've had a number of questions come throughout today's presentation. If I may just ask you to click on that Q&A tab, start at the top, just read out the question where appropriate to do so, and I'll pick up from you at the end.
Okay. Well, the first one I can see here is from Andy M. What market share do you currently have, and can you talk about the win rate in pitches? Well, I can tell you that we're around about a 27% market share, but in terms of the success of our pitches, a proportion that we get, that's probably best answered by Marsden, please.
We get probably around 75%, and that's primarily because in our industry, it's a small industry, and our customers are producers, line producers and production executives. So we have a strong customer base, and a lot of our work is repeat business. So things like The Crown, we've done 6 series of The Crown. Things like Peaky Blinders, 5 series of Peaky Blinders, etc., etc.
Thank you, Marsden. And from Jonathan C, for how many more years are the UK tax incentives 25% guaranteed to continue? Well, I don't think we know the number of years, but what I can tell you is this. These incentives first came in Blair's final administration. They were perpetuated under Gordon Brown. They were then perpetuated under the coalition government, and through all of the administrations since, the large number of Conservative prime ministers all get them going. The fact is that there's cross-party political support that realises that this is a growing business for the UK. They want it here, as well as the tax revenues it does bring in, as well as the jobs it does create. It's actually quite a matter of national pride to have such a booming industry, a world-leading industry, in fact. So it's very hard to see any administration of whatever colour, blue or red, changing those incentives. Other than that, Jonathan, I don't know what the guarantees are, but it would be hugely surprising if it would change. For Andy M, are there additional services you would look at to acquire organically or through acquisition? And well, Location One was a parallel business, so I think that's best answered by Marsden. But yes, we would look at other businesses. Yeah, so we are. The idea is we become a one-stop shop for production companies. So we're looking in the areas of prop storage and sustainable routes for reuse and disposal of props, driving agencies, props and technical transport. Also, there are some other areas in terms of lighting and also catering. And we're also looking at areas involving events, festivals, and TV and film. Thank you, Marsden. And from Stav J, I presume you're tendering for the new Harry Potter series. When do you envisage the tender process to end? Well, Marsden, I know you're right in the middle of this, so best answered by you, I would say. Yeah. Unfortunately, at the moment, no tendering because I've got no fixed dates to start filming, but we're in very close contact with the production company. It'll be made by a company called Bronte Film for the BBC, which is J.K. Rowling's own production company. We do a lot of work with them. I don't know if you're familiar with a series called Cormoran Strike, the detective series that's on television.
So we've done the first 3 books of those, and we start filming another one of their productions in January. So we're very close to the production team, and just awaiting dates for when they're actually going to start filming, and then we'll be tendering.
So I think we're hopefully in a strong position, Marsden, because
Very, very strong position, yeah.
It's the production teams in any film or high-end TV who hand out the work and award those contracts. So the fact that Marsden's so close to them is hugely important. For Rosita, can you insure against strikes, COVID, etc.? What can't you insure against, and is it worth it anyway? Over to you, Neil.
The answer is no, really, because the strikes are sort of forced out by force majeure contracts, so we've never really been able to cover, just like it was in a way with COVID, was sort of outside the remit to get cover, unfortunately.
Thanks, Neil.
And John, I think that's covered off all the questions that we've had through. Of course, any further questions that do come through, the team will be able to review those questions, and we'll publish responses back on the Investor Meet Company platform. John, just on that basis, if I may, just before redirecting investors to provide you with your feedback, which I know is particularly important to you and the team, just ask for a few closing comments.
Yeah, I think it's important to note that this is a well-funded, growing business that's acquisitive, that's growing organically, and it's doing all of that in an industry that's growing very, very fast in the UK, because the UK is one of the best places on this planet in which to produce film and high-end TV. So a growing business in a growing and robust market. We have a few headwinds at the moment, but ladies and gentlemen, that truly is temporary. And like just after COVID, once this strike is resolved, a tsunami of work will be coming this industry's way, and we're prepared to take full advantage of that.
That's fantastic. Thank you very much indeed. John, Marsden, Neil, thanks for updating investors today. Could I please ask investors not to close the session, to be automatically redirected to provide your feedback in order the team can better understand your views and expectations? It's only take a few moments to complete. I'm sure it's greatly valued by the company. On behalf of the management team of Facilities by ADF PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you very much.